Okay, good afternoon. My name is Adrian Goldfarb. I'm CFO of Duos Technologies Group. So let me give you the story so far. We are well known to be in what they call the intelligent technologies business. And the company started out, in fact, in the data center business, in the data center analytics business back in 2008. That was a public company. We joined up with Duos Technologies, which was a private company. They went public through us via a reverse merger. I stayed on as CFO, and I've pretty much been with the company ever since then. Key notable milestones since that time in 2020, thanks to Lukowski Brookman, we went up to NASDAQ, listed there. Of course, we hit COVID. We had a very significant management change, brought in a new CEO. And that's going to become very relevant as I take you through the rest of the story. As far as the big picture is concerned, we operate in 3 main markets now, and this is a big change from 5 years ago, where effectively we were in one market, the intelligent technologies. I'm going to cover all 3 of the markets in the time that I have available. We've also moved into the data center market via our Edge Data Center project, and we've just recently moved into the infrastructure and power. And I know the question on many people's minds is, well, what's the connection between those 3? And I'm going to cover those. Let me start with the intelligent technologies. This is our legacy business. This is where we have built some software, which we have applied now to a number of applications, but the main one was to evaluate fast-moving trains. Could also be trucks and other moving objects, but principally it's fast-moving trains, where we take, in effect, a scan of a complete rail consist, could be 100 cars, and produce all the data that is required for the railroads to be able to look at that. Our largest customers are CN, also known as Canadian National, and also Amtrak, and we've been working in that market for a number of years. We are extremely IP rich. We just secured yet another patent in this whole thing, and as far as the methodology of scanning moving objects, as far as trains are concerned, we effectively own the IP for that, and it's a development of many years. As I mentioned, there's a lot of talk, in the past probably year or so about AI. We have actually been working with machine vision and AI for many, many years. And the key point on this particular slide is, in addition to all the monitoring that we do, is the last bullet on there, which is high-speed processing done at the edge. And the reason that's so important is that when we built out our system, when we conceived of doing all of the processing, you can imagine with all the vision of looking at rail cars, the amount of data that produced, the amount of processing and analytics was far too great to be backhauled over the cloud. So what we did was, for each one of our rail car inspection portals, we currently have 13 that are in production. We have another 2 that are being built in Secaucus for Amtrak. Each one of those has an edge data center that's by it. And that's very relevant for the second business that we moved into in 2024. Let me just talk about the existing business. The distinction I have to make is that the business we're in is a fairly difficult business. As far as building out the technology, we also have to build out the market, which, for those of you, this is a Microcap conference, everybody's involved in Microcap some way. It is difficult for a small, and at that time, relatively undercapitalized company to not only take on and invest all the money in the technology, but to also to be able to build out that market. And the result has been that we were very capital intensive. Our results have been lumpy for a number of years. It was based on capital expenditures by the railroads, depending on what was going on in the economy. And so our results tend to be varied. We've had a high of $15 million in a year. We've had a low of about $7 million, and we've been around the $7 to $8 million range in the last few years, other than the one big year. So we've basically reformatted the model for that. There are 3 components to our existing business model in the intelligent technologies market. Number 1 is we are continuing with the capital equipment sales. We have the railcar inspection portal, which I've talked about a little bit. We've also introducing what we call the modular RIPS. RIPS is an acronym for Railcar Inspection Portal. So the modular RIPS is now to take something that might start at about $2.5 million and in effect have a $500,000 version of that, which on a train might just look at the sides and the undercarriage and other various components. And this is a way to take and expand out the market for people that say, I don't have $2.5 million to spend, but I might be able to spend $500,000 on that. It greatly expands the market. So we will continue in that. Our target market there is the Class 1 railroads, for which we have approximately 50% of the markets for that. Long distance, high speed, and local transit. As I mentioned, we have a major project, probably our largest project with Amtrak, building 2 massive, what I call super portals up in the Secaucus region, and they will analyze the Acela 21 trains when they start running. Just to give you an idea, those run at 125 miles an hour plus. We can scan all those at that speed. Typically, they won't be going as fast in that area, but if they were, we could scan them, and we present results then to the client within a minute. And that's why the use of the edge data center is so important, and I'm going to come on to that. Our expected annual revenue, 2025 and 27, I'm not going to spend a lot of time on numbers. We're coming up to producing our 10K at the moment, but I can tell you the expected annual revenue on the CapEx side will be between $5 million and up to $15 million over those 3 years. And our gross margin is typically 30 to 40%. The big improvement that we're making now is we've branched out into software and services. And the big change there is that when you're doing CapEx sales, it's a relatively small market. There are only 6 Class 1s that are across North America. You can add an extra one if you count Ferromex down in Mexico. They happen to be a client of ours. So we've come up with something now, whereas either using the customer's portals or using ones that we may build on the track, capital dependent, is where we'll collect all the data. And that massively opens our market up to be able to sell to 3,000 plus railcar owners and lessors, a huge improvement from the market. Once again, we are driving the market on this. So that's a tall order for as a small company. But we're starting to make progress on this. And I've mentioned Amtrak. Amtrak happens to be the lead subscriber for that. And they pay us several $100,000 a year for access to that data on their, I was talking about the high speed earlier, on their long distance trains, where we have portals in effect. We also do sell AI algorithms, APIs, and we do support at the same time. The expected annual recurring revenue, so we're moving now into recurring revenue business, is between $3 and up to $7.5 million over the next 3 years. And we do expect very high margins on those, somewhere in the 80 to 90%. The third area of the business is one that's been existing, which is we do support for those portals. Typically, expected ARR on that is somewhere between 2 and 5 million. Once again, the margins are pretty high on that. So there's, as the slide says, there's 3 fundamental components to support the growth of that business, and we will be continuing on to that. So let me move on to now what the company has done in the last 6-7 months. And this is the part, this is one of the reasons I was anxious to get up and talk to the investment community, because we fundamentally transformed this company. Just to talk a little bit my background, as I said, I came to the company in 2015 when we took Duos public. Been the CFO almost all of that time. I was supposed to semi-retire in 2022, and then due to a change in management, I came back in 2024. And our CEO, Chuck Ferry, is very much leading the charge to grow this company from being call it a $10 to $15 million a year company into absolute multiples of that. And one of the things that he set down the priorities when I rejoined as CFO back in May of 2024 was he wanted to expand the company into a number of different areas. So this part of the presentation is now talking about everything we've done in the last basically 6 months. So let me start with the new edge of computing. We formed a new subsidiary which is called Duos Edge AI. And the reason I gave you the backdrop on the other business, if you remember, I told you that each one of our railcar inspection portals has an edge AI data center that goes with it. In July of 2024, we formed this division, and most importantly, because good management is everything, we hired a gentleman by the name of Doug Recker. Doug Recker has about a 30-year history in the business of data centers. He's built legacy data centers, and he actually sold a business where he was involved with the edge data center business. So he came to us and said, hey, I'd like to take your edge data centers and move those into markets without having the encumbrance of the railcar inspection portals along that. So we pretty quickly agreed a business model, and Doug has been extremely successful already to grow into that. What the Duos Edge AI business is all about is a completely different business model. I can liken it actually to the real estate model. So we build these edge data centers. They're typically a little bit larger than the ones we would supply with the railcar inspection portal. They typically have 15 cabinets in there. And the reason it's like the real estate business is we will locate a piece of land, we will put one of these down, we'll get an anchor tenant, and then effectively it just becomes something that just generates cash for us. We have to make the initial capital investment, and I'm going to talk about that in a few minutes. But what we do is then rent out that cabinet space. But what you want to do is have an anchor tenant. It turns out that Doug has a very good relationship with a number of people in those markets. But rather than trying to compete at the high end, we've picked what's called the Tier 3 and Tier 4 markets. So we've already had some great success in Texas with introducing these edge data centers to the Texas regional schools. There are approximately 20 regional school districts. Our first client was Region 16, and with that, we deployed the first one. In fact, it was just featured on a local WABC yesterday, where we were interviewed because that system is up and running. So the school is going to take around 5 cabinets from that. We also happen to be providing some power with that. And then the rest of that data center will get filled out with local clients. And they could be big companies, big Fortune 500 style companies who happen to want local processing, just in the same way that we needed it for the RIP. The business is brand new, as I mentioned. It's only in the last 6 months. Our plan is to have about 15 of these edge data centers in place by the end of this year. And we expect to exit this year on that business alone with an ARR of about $3.5 million. And as you notice, the slide says up to $65 million by 27, which is quite a bit of growth if you imagine the capital has to be raised for that. So the business has expanded a little bit beyond the edge data center. And it came from, we started with an area in Texas called Pampa, and you can look this up on our website. We put out a press release, I believe it was December 16th, where we started with the regional school district. The number escapes me. But it started out basically as a 2-edge data center, and it seems to have grown from that to a massive project now where the local Pampa, they call it the Economic Development Community, wants to build out, in effect, a massive data center area, which they will attract some of the biggest players. And by the biggest players, you know who they are, okay, that's coming into that. So how does a small company like Duos play in that market? So that gives us, in fact, here's the press release on the, okay, it's the picture of us standing effectively in a greenfield site. We already have deployed 2 edge data centers down to that, but this is a global development. And the question is, how do we grow? How does a small company like us grow into that? And that really leads to the third business, which is what we're calling the new age of infrastructure. So I mentioned that we have a CEO. We did a complete management change back in 2020. Chuck Ferry is our CEO, and he actually used to lead a company called APR Energy. He led that for a number of years, grew that up into about a $500 million a year business. So clearly, leading us at Duos, we were very lucky to snag him in 2020, but he wasn't going to be happy with a business that was doing 10 million. So he's been working for a number of years on the strategy to grow us out. During that time, we added a lot of staff from APR Energy, and so put us in a very, very good place to now take advantage of the gold rush that's going in energy, local energy, what they call behind the meter for local data centers. We formed a company called Duos Energy. In fact, it's Duos Energy Corporation. It's a wholly owned subsidiary of ours, and the plan is, as the slide says, was to offer solutions where metered power is just not available. For example, in some areas, you might have a local authority that has maybe 5 gigawatts of power available, okay, or being in use, but none of it is available to build out these new data centers. And so what we do is, the plan is to provide these gas turbine generators, which is the business that APR Energy was in. And the story goes that APR Energy, since Mr. Ferry left there in 2020, was they were owned by a very large shipping company, and I don't think their heart was totally in that business, and the business was sort of going nowhere. And so Mr. Ferry reached out to the management there and asked if they might be interested in selling the assets. He wasn't interested in the business, we wanted the assets. And the assets consist of approximately 30 gas turbines representing about 850 megawatts of power. So there was interest expressed, and it was clear that Duos on its own was not going to be able to raise that kind of money, not without doing some dilution, which would have been untenable. And so consequently, the management team reached out to a very large bank, and that bank put us in touch with Fortress Investment Group. Fortress Investment Group evaluated the plans and said they very much liked what they saw. They wanted Chuck basically to lead the team. They saw that we had all the people that were capable of installing and managing and running those. And so we put effectively together a buyout with them where Fortress Investment Group formed a separate company. They bought all the assets. It was a several $100 million deal. I'm not allowed to disclose how much, but we've pulled that in. So let me just say this is the press release. The way that deal was structured, because we had all the management and we were effectively standing up a new company, Duos management team and its workers will now run that business for at least the next 2 years, okay? And that was pressed for us as a $42 million asset management contract. In addition to that, after the deal closed, which was December 31, it was also revealed that we not only had a 5% equity stake in the new venture, and I'm going to show you a chart of all of this, but Fortress also advanced about $5 million in effectively free financing to us, which considerably helped bolster our balance sheet. I'll get onto the financials in a little while and just give you some commentary on that. But obviously, this is an absolute game changer for Duos as the public company, as the public microcap company, and puts us now on the road. And we're in now 2 other businesses where we don't have to basically drive the market development of that. Unlike the legacy business, where we will continue to push over a number of years and the growth probably will be a little bit slower. In these markets, particularly now, we've entered what management likes to call the gold rush, this whole combination of data centers and power. And we were in a very, very nice position in that everybody wants our assets now. So let me talk about, I'll come to questions, I'll finish up and come to questions in a moment. Let me just talk about the credentials, and I'll cover a little bit of financial data, and I won't go into all the details of the balance sheet and the P&L at the moment because it's not really relevant to the new business, but I'll give you some perspective on that. So just to give the kind of overview of the story, because it can be a bit of a complex story if you're not in the company and haven't been living with it. You basically have Duos Technologies Group. That's the NASDAQ-listed company. We have a 5% ownership stake in the new APR Energy. APR Energy is run by our people. It's all of our people that run that. We're paid via the asset management contract to run that business for at least the next 2 years. You've got the 3 divisions that I've talked about, and then APR Energy is set up now to provide energy, behind-the-meter energy, for not only data centers, but they can go back into what I would call the legacy APR Energy business, where they did projects all over the world, in places like Bangladesh, in Argentina, just places that are complex to do it. And the reason that we can do this is we're not now trying to hire 100 people to staff up and get it. We either had the people working for us, or we've hired them in from what was the APR Energy. So it was an asset management purchase using Fortress Investment Group, and then hiring the people in to do that. I've mentioned the management team. We're led by Chuck Ferry. Just to give a little bit background on Chuck, he's a very unique senior manager, 26 years in the U.S. Army, leading Joint Forces and Special Operations. Joined Duos in 2020. As he said, he came from APR Energy, and he's effectively, since he left the military, done 2 turnarounds and moved both of those companies up into multi-hundred millions. So there's no reason to say that he's not going to do the same thing with Duos. As far as the rest of the management team, we're divided up into 3 areas. There's myself and Jeff Netchai, who's the Chief Technology Officer and runs now the legacy business. Then we have a brand new Chief Operating Officer, Chris King. Doug Recker is the 30-year veteran in the data center market. Chuck and Chris and Doug all have joint roles. So Chuck is both the CEO for Duos Technologies and he's the CEO for APR Energy. And the same thing applies to Chris and to Doug. Doug is the Chief Commercial Officer for both companies. And then over on the right-hand side is Lee Wilson, a longtime a veteran of the private equity markets. He's the president of APR Energy. And actually my successor and predecessor, Andrew Murphy, who has rejoined APR Energy under the Duos management team, and he's the CFO over there. And Andrew is, if you've ever sat through one of his presentations, very, very impressive and is definitely going to be leading as far as being the CFO of these companies going forward. Just a last thing, this slide is more just to give an overview of how this works. You've got APR Energy, okay, which is the main driver of all the power from this. And Duos and APR work collaboratively on projects where it makes sense. They're obviously going to take the power side of it, but obviously there's a fair amount of muscle behind that company given the relationship with Fortress. Duos Energy is on the right-hand side. That's our energy company. And through the asset management agreement, we work collaboratively. I'm not going to present P&L and balance sheet today. The P&L, if you want some guidance, which I'm not really giving guidance, but Duos's revenues for 2024 will be very similar to what we've had in 2023. So as I would like to say, not much to write home about, kind of it's just a reflection of the slow-moving part of that market. What is going to change very greatly is the balance sheet. The balance sheet is immensely stronger and will be reflected in the 2024 10K. First of all, the 5% ownership will be reflected. I can't give you a number today. We're finishing up the valuation on that, but will make a significant difference to the Duos balance sheet. Also, cash-wise, our cash is vastly improved. We were very low on cash for quite a bit of the last part of last year. Part of that was a little bit of a deliberate ploy by management to not over-raise and hoping that we could move through with issuing as little stock as possible. We got rid of all of our warrants during that time, so we have a very, very clean cap structure, and that's what I'm prepared to present today. So about 9.3 million in common stock. We have about 1.9 million shares in restricted stock, and that is all owned by the management. We all have very, very long-term, we're all committed to the business. We all have cliff vesting three-year stock. So the management is absolutely committed to driving this to be a success. There's approximately 570,000 options, which are employee options. And then we have a series of convertible preferreds, Series D and Series E, which was how we raised money last year. And I can tell you that the Series D and the Series E is effectively owned by two of the largest shareholders in the company. So we have a very strong cap structure, very well managed. Our float's starting to get a little bit bigger. The share trading volume has been picking up a lot, particularly in the last few weeks, as the expectations of considerably improved results make their way into the market. Total share count fully diluted is around 17 million shares, and our market cap today, the basic market cap is about 61 million, which, to give you a perspective, 5 years ago when we went up to NASDAQ, our market cap was about 20 million. And with that, that's the end of the formal presentation. I'll be very happy to take some questions. It's under a profits interest thing. So the way the structure is arranged, there's preferred shares, which Fortress owns, okay? And then we have common shares. We're the only owner of this 5% common shares. We're the owners of those. So there's various things, in the private equity. I don't come from the private equity world, but, there's MOICs and things like that we have to get through. But in essence, there'll be a valuation that appears on our balance sheet. And then as the years go on, assuming they're making profits, we will pick up some of that as we go along. The expectation that came out when we did the deal is that 5% will be worth somewhere probably in the $30 to $60 million range at some point in the future. I'm talking the next few years. So excellent question. Thank you for pointing that out. We are just the host, the co-location. We don't provide any service. So what's nice about that from my standpoint, we are on the slow end of the depreciation curve. I'm not worried about having to replace service. So no, we're set up so that they can put in the most powerful servers that they need to put in. By the way, you mentioned raised floor, so I'll take it on myself because that's phraseology I used to use because long time ago, I was with IBM. So I work for IBM as well. So we used to do raised floor data centers. Apparently we're out of it. No more raised floor. It's now because the servers are just too heavy. They can't wait. So it's all basically flat floor. But these data centers are like proper data centers. It's not just a hut with a few racks in it. It's got I know this is not very politically correct. They call it a man trap. So it's got very great security, special air handling. So remember, these are in hostile environments, which is one of the areas that Duos has experience in. So when you walk in, if you walk in, it could be a field. You got muddy shoes and everything. So this air handlers takes off all the dirt from you, so it's not getting into the servers.
What about water?
Yeah, so there's chillers, okay, as you need water. The big thing, though, is the provision of networking and power. So the funny thing is that networking is relatively available in these areas, which is what helps work with the schools. And it's very nice for us when they're using the networking because that's a source of extra revenue for us as we interconnect between the cabinets. But we don't touch the server size. So that's the difference between the ones we deploy for rail, where obviously we own the servers. A good question. Yes, yeah. So right now it's set as an asymmetric component. It's hard for me to really answer that question. I think the reason it's set at 2 years is obviously we think we're a great management team. We think we're a great operating environment. This is the first time Fortress is working with us, so we have to prove that out.
So
it can be extended.
Intention that it's going to end. It just
As far as there's room for extension in there. Other environments could happen. Maybe they want to build out their own platform. But the thing about it is, for these 2 years now, now speaking from the Duos side, is it provides a very stable source of revenue. So because effectively the staff, whatever staff we have, gets deployed to that, we make a turn on that. What's nice about it, though, is that in the energy business, there are a lot of extra services that go with that, particularly when you're standing up a new power source. There's mobilization that goes into there. Some of the equipment, some of this equipment is quite old, but it doesn't matter. It can be refurbed. And so any of those things, we make a very nice turn on the work that we do with that. And that's going to help Duos' margins, such that our expectation is that for the first time, certainly since I've been around the company, the likelihood is we're going to break even to be profitable this year at the public company. Sure. So pre the addition of these two divisions, I had to get to about $27 million to just break even in that business. One of the beauties about this particular structure, beauty as far as a CFO is concerned, okay, is that because we're making now such good use of the staffing that's in this. So we were about 60, 65 people before with the one business. We dropped over time deliberately to about 50 people during the year. And then as these divisions came on, we're probably adding about 50 people. But those 100 people are now spread across 3 different revenue streams. And so because we've done so much of the development for the legacy business, our cost of operations and therefore our operating margins get a lot higher, just because we're not trying to carry as much R&D costs, we're not trying to carry as much SG&A and so forth. So the legacy business, I don't know that it's going to break even on its own in 2025, but I think it has a good chance of doing that, depending on what the projects are. But it gives us much greater, so if the railroad business goes slowly, which has been unfortunately the theme for the past several years, we are now scaling to that. So we've definitely cut down on the expenses. And it's one of the reasons why we were able to, even though we lost quite a lot of money last year, we were able to survive without having to do very large raises and do all sorts of ridiculous, banking deals just to stay alive and go through that. So we will be making an improvement on that. But the profit picture in 2025 is going to be vastly better. Our expectation is we'll be multiples of the revenue that we did, I'm expecting to do in 24, and I do expect to be break even and profitable. Yes, you do, but let me give you a caveat on looking at it that way. The 3.5 million ARR is with the expectation that we will put in 15 of these edge data centers. Now that requires some capital to do that. I have the first six are already done as far as being able to finance those. We did three of them with debt, a debt which we're probably going to pay off because of our good cash flow at the moment, probably in the next 3 months. And 3 of them we did with a master capital lease. It was a deal that we worked out with Generate Capital because they had 3 units and they wanted to offload them. They loaded them to us because we had clients for them. We still have to finance the next 9, okay? So the question is, and it's part of what I've been talking to people here, are we going to do that with debt? Are we going to do that with equity? And my answer is I'm not sure at this stage exactly how we're going to do that. But the 3.5 million is the expected outgrowth at the end of 2025. The growth to 65 million, and that's why there's an asterisk on the chart, that could be from 60 plus edge data centers, or it could be what I'm calling the equivalent. So I mentioned the Pampa project. So the Pampa project is scheduled to build 4 major data centers into that. So instead of laying down 20 or 30 edge data centers, we may just build a full data center. But obviously, that's orders of magnitude of capital that's required, and that's where the APR do-us relationship comes in, and our relationship with Fortress in terms of how that gets financed. The margins on the edge data center business is about 70%. Yeah, 70%. Everything we're looking at right now is services, software, everything has to be ARR. The only real capital projects that we're doing where we build something and sell to someone is in the legacy business. And the only reason that really is there is because rail is a relatively slow-moving business. We have projects that are lined up that just seem to take a long time to get put into place.